A pleasant day to each and everyone. Today I'm going to discuss measures of return and risk. The holding period return measures the total gain or loss that an investor owning a security achieves over the specified period compared with the investment at the beginning of the period. The return over the holding period usually comes from two sources: changes in the price, so we expect either a capital gain or loss, and income in the form of dividends or interest. The holding period return is the total return on an asset or investment portfolio over the period for which the asset or portfolio has been held. The holding period return can be realized if the asset or portfolio has been held, or expected if an investor only anticipates the purchase of the asset. Look at our formula. Holding period return is equal to income generated plus the difference between ending value and initial value divided by the initial value. The income generated refers to any income earned during the period, which may be in the form of dividends or interest. Ending value refers to the value of the asset or the portfolio at the end of that period. And the initial value refers to the value of the asset or portfolio at the beginning of the period. Generally, the holding period return, or HPR, is expressed in percentages. Frequently, it is annualized to determine the rate of return per year. Get your calculators ready so you can practice computing with us. In January 1, the price of an ordinary share in Company B was 100 pesos. On December 31 of the same year, an ordinary share of Company B was selling for 125 pesos. 125 pesos is the price of an ordinary share of Company B at the end of the year, and 100 pesos is the price of an ordinary share in Company B at the beginning of the year. We simply get the difference, then divide that by the initial value, which is 100. And our answer will be 0.25 or 25%. For example number 2, we use the same data given in the previous slide, except that this time, we're going to assume the payment of dividend of 5 pesos per ordinary share. Using the same formula, we have 5 pesos plus the difference between the ending value and beginning value divided by the beginning value or initial value. So, that will be 5 plus 25 divided by 100. And we get an answer of 0.30 or 30%. In a slide presented earlier, we mentioned that the HPR is annualized to determine the rate of return for every year. Sometimes the HPR is converted to an annualized rate for comparison purposes, and the formula is the quantity of 1 plus HPR raised to 1 over n minus 1. 1 is constant, and n refers to the number of years. The holding period can range from a couple of days to multiple years, so annualizing the returns is necessary to compare the returns of different investments. For instance, the absolute HPR of an investment could be less than that of another investment but be greater on an annualized basis. The annualized holding period return makes it easier to compare returns among investments with varying holding periods. Let us take a look at the example given. Consider an investment that costs 2,000 pesos and is worth 2,500 pesos after being held for 2 years. The investment earned a dividend of 100 pesos over the 2-year period. How do we compute for HPR and the annualized HPR? First, let us compute for the holding period return. Income generated or the dividend earned is 100 pesos. Then, we add the difference of 2,500 and 2,000. Then divide that by 2,000. So we have 100 plus 500 divided by 2,000. And we get an HPR of 0.30 or 30%. Now for the annualized HPR. 1 plus 30%, which is the HPR, raised to 1 over 2, 2 being the number of years given in the problem, minus 1. Using our calculators, we will be able to compute for 0.14 or 14%. Let us now move on to another example. This time, we compute the holding period return for a portfolio of investments. An investor may have the option to have as many securities or have as many investments in a single portfolio. In this example, we assume that the investor has 3 securities in his portfolio. Security A has a beginning value of 1 million and an ending value of 1,200,000. Security B has a beginning value of 4 million and ending value of 4,200,000. Security C has a beginning value of 15 million and ending value of 16,500,000. For us to compute for the holding period return, let us first get the sum of all beginning values and the sum of all ending values. The beginning value is 20 million and the sum of ending value is 21,900,000. So we get the difference of 21,900,000 and 20 million, then divide that by the beginning value, which is 20 million. And we get a holding period return of 0.095 or 9.5%. Then we move on to the mean rates of return. The first formula is that of arithmetic mean, which is also known as the arithmetic average return. We simply know this as average. So all we have to do is to get all the returns divided by the number of returns. For geometric mean, this provides a more accurate representation of the portfolio value growth than an arithmetic return. In mathematics, geometric mean is the average value or mean, which signifies the central tendency of the set of numbers by finding the product of their values. Basically, we multiply the numbers all together and take the nth root of the multiplied numbers, where n is the total number of data values. Let us now move on to an example. Consider an investment with the following data. On the first year, the beginning value of the investment is 100 and ending value of 115. On the second year, we have a beginning value of 115 and ending value of 138. On the third year, the beginning value is 138 and the ending value is 110. First, let us get the holding period return for each of the period. For the first year, the HPR is 0.15. As we have already learned earlier, we simply get the difference between the ending value and beginning value, then divide that by ending value. On the second year, the holding period return is 0.20. And on the third year, the holding period return is negative 0.20. Negative because the ending value is lower than the beginning value. So we now substitute the formula of the arithmetic mean with the holding period returns. 0.15 plus 0.20 minus 0.20 divided by 3. And we get an arithmetic mean of 0.05 or 5%. This time, we go to the geometric mean. Take note that in the formula of the geometric mean, 1 is a constant. So, we simply substitute the given formula and we come up with the quantity of 1 plus 0.15 multiplied by 1 plus 0.20 multiplied by 1 minus 0.20 raised to 1 over 3, 3 being the number of periods, then minus 1. So we have 1.03353 minus 1, or our geometric mean is 0.03353, or 3.35%. Did you get that? This time, we compute for expected return. Do not be overwhelmed with this formula. It may look difficult, but it's actually easy. Just do not forget to look out for the probability of return and the possible return. Using the formula in the previous slide, we now have this example. An investor is estimating probabilities for each of the economic scenarios based on past experience and current outlook. On the table, on the first column, we see 3 different economic conditions. On the second column, we have the different probabilities of earning a specific rate of return given the economic conditions. And on the last column, we have the rates of return. So in a situation where the economy is strong and there's no inflation, there is a 0.15 probability of earning 0.20 rate of return. In an economic condition where the economy is weak and has an above average inflation, the probability of earning or getting a rate of return of negative 0.20 is 0.15 or 15%. And if there are no major changes in the economy, the probability of earning a rate of return of 0.10 is 0.70. So to get the expected return on that investment, we simply multiply the probability of return by the rate of return in all those 3 economic conditions and get the sum. So we get an expected rate of return on the investment of 0.07. Measuring the risk expected rates of return. Statistical techniques are used to compare the return and risk measures for alternative investments directly. 2 possible measures of risk or uncertainty have received support in theoretical work on portfolio theory: the variance and the standard deviation of the estimated distribution of expected returns. Standard deviation and variance are both measures of data variability. When it comes to investing, it is used to identify the risk level of an asset's returns. For investors, the standard deviation essentially shows how much investment returns tend to deviate from a particular set of historical data. That data is measured either against itself or as compared to an average or benchmark. Standard deviation in investing works by measuring how often stock prices tend to stray from the average. Investors use it as a tool to measure market volatility and predict performance trends. In simple terms, investors use standard deviation to measure risk. Lower standard deviation is not always preferable. It instead depends on the individual investor's risk tolerance. Variance is used by investors and financial analysts to determine volatility. Investors use variance to assess the risk or volatility associated with assets by comparing their performance within a portfolio to the mean. For example, you can use the variance in your portfolio to measure the returns of your stocks and ensure proper diversification across assets with varying volatilities. In short, Variance measures how much a stock's or portfolio's return varies from its average. Standard deviation, on the other hand, measures the volatility of these returns. The bottom line is that both standard deviation and variance are used by investors as measures of risk. Actively monitoring a portfolio's standard deviations and making adjustments allows investors to tailor their investments according to their personal risk tolerance. While both metrics are used as fundamental risk measurements, remember that they are not guarantees of future performance. Now we move on to sample computations for variance and standard deviation. Note that the numbers that appear on this slide are the numbers that we had used earlier in the example when we computed for expected return on an investment considering three economic conditions: 0.15 and 0.20, 0.15 and negative 0.20, 0.70 and 0.10 all came from the data given on that slide, and 0.07 is our expected return for an investment, giving us now a variance equivalent to 0.0141. Then we compute for standard deviation, which is simply the square root of our variance. So, the square root of 0.0141 is 0.11874 or 11.87%. Now we get the coefficient of variation, where the answers we derived for standard deviation and expected rates of return are now used. In finance, the coefficient of variation allows investors to determine how much volatility or risk is assumed in comparison to the amount of return expected from investments. Ideally, if the coefficient of variation formula should result in a lower ratio of the standard deviation to mean return, then the better the risk-return trade-off. Take note, the coefficient of variation formula or calculation can be used to determine the deviation between the historical mean price and the current price performance of a stock, commodity, or bond relative to other assets. So, we use the numbers we computed earlier and substitute the formula for coefficient of variation. Our computed standard deviation was 0.11874 and our computed expected rate of return was 0.07. And we get the quotient, and that is the coefficient of variation, which is 1.696. That ends my short presentation. Thank you. Class dismissed.